Hello everyone, I hope that all of you will be fine. Students, in this video you are going to learn about sales of non-current assets and disposal account. So let's start our video. Before recording the sales of non-current assets, let's see that how we can record the sale of goods. It's very important that you understand the difference between goods and non-current assets because the goods are dealt in a different way and non-current assets they are dealt in a different way. So the difference between goods and non-current asset is this, that goods are those items which a business purchases to resell in the future and to earn profit from that. Whereas non-current assets are purchased because we want to use them in our business and they're used for more than 1 year. So the main difference between goods and non-current assets is this, that goods are purchased because we want to resell them and we want to earn profit from that. Whereas non-current assets are purchased because we want to use them in our business and they are used for more than 1 year. So when you are selling goods, in that case, the journal entries will be as follows. So number one, let's assume that you are selling goods on cash. So if you are selling goods on cash, in that case, cash account will be debited because cash is your asset. You are receiving cash. So your asset is increasing. So cash account is going to be entered on the debit side. And sales account will be entered on the credit side. Remember one thing, when you are selling goods, you use sales account for selling goods. So sales account will be credited over here because your income is increasing. Sales is your income. So whenever your income increases, it has to be entered on the credit side. So the journal entry, when you sell goods on cash, cash account will be debited and sales account will be credited. Now the second case, when you sell goods and you receive check instead of cash. So over here you cannot debit cash because you are not receiving cash. Instead you are receiving a check which you are going to deposit in a bank. So instead of cash, now the bank account will be debited. The bank account is also an asset, and we know that asset when increases is going to be on the debit side. So when you are selling goods and receiving a check, this means you are going to deposit this check into the bank and your bank account will increase. So the asset will increase, and that's why it's going to be written on the debit side. And sales account will be credited because when you're selling goods, you use sales account for that, and sales is an income. And whenever the income increases, it has to be written on the credit side. That is the case when you sell goods and you are going to receive cash in future or you are going to receive a check in future. So this means that you are selling goods on credit. In that case, you cannot debit cash because you are not receiving cash at the same time. You cannot debit bank account because you are not receiving a check. Instead of that, you debit another account which is known as trade receivable account. Trade receivable is also your asset because trade receivable are those parties from whom you have to receive cash in future. So trade receivable is your asset. It will increase because you're selling it on credit, and sales again will be credited because your income is increasing. Remember, it does not matter that you receive cash or you do not receive cash. You have to record the sales because in accounting we follow accrual concept and we have to record the credit sales as well. Irrespective of this, that the cash is received or not, you have to record the sales. So and these will be the general entries when you sell goods on cash or when you receive a check or when you're selling goods on credit. Now let's see sale of non-current assets. Sale of non-current asset is very different from sale of goods. And before we see the transactions for sale of non-current asset, let me show you the extract of the balance sheet. In balance sheet, which is also known as statement of financial position, we write non-current assets and we have three things: cost, PFD, which stands for provision for depreciation, or sometimes we call it accumulated depreciation. And then we have NBV, which is net book value. So we have these three items: cost, PFD, and NBV. Now, what is cost? When you purchase a non-current asset, you have to pay a purchase price for that. So that purchase price is one of the items which are written in the cost, plus any expense which is incurred before the use of an asset, that is also included in the cost of an asset. For example, if I buy a machine for 50,000 and I pay 10,000 for installation charges, then 50,000 plus 10,000, the total cost is going to be 60,000. Or if I buy a machine for 50,000 and I pay 5,000 for delivery charges, then 50 plus 5, the cost is going to be 55,000. So cost means the purchase price plus all expenses before use of an asset. And remember, in accounting, we follow historical cost concept, which says that the assets should be non-current assets should be written at their original cost. So you have to write over here the original purchase price plus any expense which is incurred before the use of an asset, the first use of an asset. Then we have PFD, which stands for provision for depreciation, or we also call it accumulated depreciation. Now it is different from depreciation. Depreciation is for 1 year, whereas provision for depreciation or accumulated depreciation means the depreciation which is charged on the non-current asset in the whole life of non-current asset. So it's not depreciation for 1 year. It's depreciation for that year plus all the previous depreciation. So that is basically accumulated depreciation. NBV stands for net book value, and it is calculated by subtracting provision for depreciation from cost. So these are the three items which we write in the balance sheet when we write non-current assets. So let's take an example. For example, we have a furniture. The cost is 50,000. The provision for depreciation is 20,000. So the net book value is going to be 30,000. Now let's assume that we have disposed of this furniture. So what are we going to do now? It's not going to be as simple as the sale of goods, where you have just entered one transaction. Over here, you have to follow the following steps. Number one, you have to remove the cost of non-current asset. So this is the cost of non-current asset, which is written in your books. You have to remove this cost of non-current asset from your books because you're disposing of this non-current asset. Then second, you have to remove the provision for depreciation for NCA. Now, this non-current asset which you have sold off or which you have disposed of, you have to remove the provision for depreciation for this non-current asset as well. Then the third, you have to record the sale proceeds for NCA. So when you're selling these non-current assets, most probably you are going to receive cash, or you're going to receive a check, or you will receive cash in future, or maybe it's a part exchange. But in any case, you are going to receive any kind of sale proceeds. So that sale proceeds has to be recorded as well. So the third thing is that you have to record the sale proceeds for NCA. And the fourth one is that you have to find profit or loss on sale of non-current assets. So these are the four steps which you have to follow when you sell a non-current asset. So in the next slide, we will see that how we record these transactions and how we prepare disposal account. Okay, so these are the four steps which we have seen. You have to remove the cost of NCA. You have to remove the provision for depreciation for NCA. You have to record the sale proceeds for NCA, and you have to find the profit or loss on sale of NCA. Now let's take the same example in which we have a furniture. The cost of furniture is 50,000. Provision for depreciation charge is 20,000, and the net book value is 30,000. So let's see how we are going to record this. I'm going to first record the journal entries, and once I'm done with the journal entries, then we'll prepare the disposal account right there. Okay, so the first one, you have to remove the cost of NCA. So how to remove the cost of NCA? As we know, when we purchase non-current assets, the non-current asset is debited because your assets increase. And whenever the asset increases, you have to write it on the debit side. Over here, your assets are decreasing because you're selling your non-current assets. So non-current asset is going to be entered on the credit side. If you assume that it's furniture over here, then you write furniture account on the credit side, and the cost will be written over here. It's very important to understand that the cost will be written over here. So non-current asset will be credited with the cost of 50,000. Now the problem is that the journal entry requires both the debit side and the credit side. But over here we have only the credit side. On the debit side, we cannot write cash because this 50,000 is the original cost of this non-current asset, and there are very rare chances that we are going to receive the same amount. So we are going to receive the different amount. We are going to receive something different from 50,000. So we cannot write cash over here. So we do not have any account over here on the debit side. So we open a temporary account. Temporary account means the account which will have a zero balance at the end. So that temporary account over here is known as disposal account. So this disposal is temporary account which is opened in this case, and it's written on the debit side, and you'll see at the end it will have a zero balance. So the first journal entry will be disposal account will be entered on the debit side, and non-current asset will be entered on the credit side. So this is the first entry to remove the cost of NCA. Now the second, you have to remove the provision for depreciation for NCA. Now provision for depreciation, remember provision is basically liability of uncertain timing and amount. Sorry, provision is liability of uncertain timing and amount. And we know that liability when increases, it has to be on the credit side, and when it decreases, it has to be on the debit side. So this means that provision for depreciation should be entered on the debit side because we are removing this provision for depreciation. Secondly, this provision for depreciation is a contra asset account. This means that it is subtracted from non-current assets. So non-current assets, they have the debit balance. So if it is subtracted from a debit balance, this means it's a credit balance. So whenever the credit balance decreases, it has to be entered on the debit side. Third, the entry when you transfer depreciation to provision for depreciation, that is depreciation debit and provision for depreciation credit. So whenever the provision for depreciation increases, it has to be on the credit side. When it decreases, it has to be on the debit side. So I told you that it's a provision. A provision is basically a liability of uncertain timing and amount. And liability when increases, it is credit. When decreases, it is debit. Secondly, it's a contra asset account. It is subtracted from non-current assets, so it has a credit balance. Third, the journal entry when you pass for depreciation is depreciation DR and provision for depreciation CR. Whenever there is increase in provision for depreciation, it is entered on the credit side. So over here we are removing provision for depreciation. So there is a decrease in provision for depreciation. So provision for depreciation will be debited, and we don't have any other account, so we will put disposal account again over here. It's a temporary account which you'll see at the end will close down. Third, so we have done the first step and the second step. We have removed the cost of NCA. We have removed the provision for depreciation for NCA. The third step is that we are going to record the sale proceeds for NCA. Now the sale proceeds can be in the form of cash, or you may receive a check, or you may receive cash in future. There can be part exchange as well. For now, we will assume that we are selling this non-current asset on cash. So if you are selling this non-current asset on cash, the cash account will increase, of course. So the cash account will be debited because your asset is increasing. Let's assume that we sold it for 35,000. And then again, we don't have anything on the credit side, so we put disposal account, a temporary account over here on the credit side. Let's assume if we sold it for check instead of cash, we are going to write bank account over here and disposal account on the credit side. If we are selling this non-current asset on credit, then trade receivables will be written, or account receivable will be written on the debit side, and disposal account will be written on the credit side. So this can be the three cases which you can see there. There can be part exchange as well, which we'll see in the next lecture because it's more complicated. So over here, I'm assuming that we are selling this non-current asset on cash. So cash account will be debited and disposal account will be credited. Now we have completed the first three steps. We have removed the cost, we have removed the provision for depreciation, and we have recorded the sale proceeds as well. Now the fourth step is that we have to find profit and loss on NCA. So before that, let's prepare a disposal account. Now it's very easy to prepare a disposal account from the journal entries which we have already done. So if you see in the first entry, disposal account is entered on the debit side. So write it on the debit side of disposal account. But why it is on the debit side? Because of NCA. And the cost is 50,000. So write NCA 50,000 on the debit side of disposal account. In the second entry, you can see disposal account is on the credit side. And why it is credit? Because of provision for depreciation. So write provision for depreciation 20,000. In the third entry, you can see disposal account is again written on the credit side. And why it is credit? Because of cash. So write cash over here. So if you see disposal account has 55,000, 35,000 plus 20,000 on the credit side and 50,000 on the debit side. So from where the remaining 5,000 will come is basically the profit on sale of NCA, which we will calculate now. So to find profit or loss, you have to follow, there is a simple formula. First of all, you have to find net book value of NCA sold. So if the sale proceeds which you are getting is greater than net book value, then it's profit. If sale proceed is less than net book value, then it's loss. So in this case, if we see The formula for finding net book value is cost minus provision for depreciation. So cost over here is 50,000, as you can see over here. The cost is 50,000. The provision for depreciation is 20,000. So 50 minus 20,000, you get 30,000. That is the net book value. Sale proceed is 35,000. So you can see that sale proceed is greater than net book value by 5,000. So we have a profit of 5,000, which will be entering on the debit side. So now 50 plus 5, 55,000 on the debit side and 55,000 on the credit side. So you can see disposal account does not have any balance. It has a zero balance. Now this is the profit actually, and you can pass a journal entry. First you can find a profit and you can pass a journal entry for profit as well, which is like this. Disposal account will be entered on the debit side and income statement will be entered on the credit side if it is a profit. Now what is the reason for that? Profit on sale of non-current asset is an income, which is written in income statement, of course. So income is always credited to income statement. That's why you can see over here income statement is written on the credit side and disposal is on the debit side. If it was a loss, then it will be opposite. Income statement will be entered on the debit side and disposal account will be entered on the credit side, because loss on sale of non-current asset is written as an expense in income statement. I hope that your concept is clear, and if you have any problem, if you have any query, any question, you can ask me in comments. Thank you so much.